A lot of stocks have been hit extremely hard over the past year and since their peaks during the pandemic, particularly stocks that were pandemic darlings. That's everything from consumer goods companies to companies that we thought were going to revolutionize the energy industry. But one stock that is down 84% from its 2021 peak and down 56% over the past year is Chewy. And this is no fly by night company. The company's financials have been getting better for years, now starting to turn the corner to profitability, still growing revenue. So there's a lot to like about this company. So why is the stock down as much as it is? Well, that's what I'm going to get into today, and I'm going to give the reasons that I think that this could be a phenomenal stock long term. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start this with a quick overview of Chewy's financials, because I think it's good to go back and see where this company has come from. The first thing I'm going to start with is a high level look at revenue and net income. You can see that revenue has grown sharply. 2016, just $150 million in revenue, now over $3 billion worth of revenue. So just phenomenal growth rate. The challenge is the company has been burning money for years. Now that has turned around recently. 2023, $60 million in net income, and in the past 12 months, about $12 million in net income. So this is no longer a money-losing company. It's just not particularly profitable. If we look at where their revenue comes from, there are three segments the company reports: consumables revenue, hard goods revenue, and then other products. Consumables are a vast majority of the company's revenue, and this is going to be things like pet food, and it's a big reason why 75% of their revenue is from recurring subscription customers. Customers that are just saying, hey, send me a new bag of pet food every month, and I'm going to set it and forget it. So that's a really valuable place for the company to be. The challenge right now is that the growth in subscribers or customers is starting to hit kind of a standstill. You can see that it grew really sharply between 2016 and 2022 and is now kind of leveled off. Over about the past 2 years, the total customer number is down slightly, but you can see that the positive news is that sales per active customer continues to rise. That's what this blue line is. So there's a little something for everybody here. If you're bullish on the company, you can see that there's long-term revenue growth. We're starting to move towards profitability, and those margins should continue to get better as the company gets a little bit more efficient in its operations, how it's shipping products and picking them with their automated warehouses. But on the downside, the customer number is starting to decline, and this is maybe because they've saturated the market. All the people that were going to become Chewy customers have already done so. And 20 million is a lot of customers. So while there's reason to be bullish, it's also understandable why investors may be selling off this stock. But I want to dig into the strategies that the company is implementing and see where this might take Chewy in the future, because I think ultimately that's what's going to differentiate Chewy from all of its other competitors in both retail and then especially pet retail. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, the way that I would look at Chewy is as a niche supplier in the e-commerce business. So this isn't a company that's going to become the size of Amazon, but Amazon is a competitor. So what can they do a little bit differently, and why would customers choose them? Well, they give some data behind at least the pet side of e-commerce. So why is this a favorite place to shop? Well, customers named Chewy their preferred number one destinations for their pet. That's understandable, because if you're shopping at something like Amazon, there's a million products there, and maybe don't know exactly what you're getting. But Chewy is all about pets. So they've obviously leaned into that. 5-star experience. Chewy has a better 5-star experience. And then sales per active customer. This is to that customer retention point. Once you start buying things on Chewy, you start getting them delivered on a regular basis, you're likely to be somebody who's going to be spending quite a bit of money on an ongoing basis with Chewy. So this is really the moat around the business, is that it becomes a niche supplier with very loyal customers. And you can see this in what they call their cohort data. Cohort is simply a group of people who have come in as customers. And what they do here is go back all the way to 2011 to say, what does the revenue per cohort look like? And if you go back to 2011, there's customers are spending over $1,000 per year, both those 2011, 2012 cohort or customers. So that really shows how sticky the business is, and how maybe you get a pet and you start by getting a couple of products on Chewy and you go, oh, this is easy. So now I'm going to get pet food, and then I'm going to start to get pharmaceutical products, and they're already coming to my door. So maybe when I need new bags or a new leash, this is now the first place that I look instead of it being just another place that I can shop. So I think that's really the way to think about it. These older cohorts are generating more and more revenue. So that's a positive sign for the business. The potential market is really big too. And there are three things that Chewy leans into: retail, health, and then the international market. These first two are where they're really growing right now. That's the focus of the business. Then international, highly deliberate, capital efficient approach is what they're going after. So you figure everything out in the US and then you start to move into other international markets. That makes sense as a way to grow the business long term. The challenge for Chewy has always been, how high can you push margins? How efficient can you be with your operations? Because this is not a business where you're going to be able to charge 50% more than other retailers, because there's other options, other places you can shop. So you're starting to see some of that here, is that these margins are starting to level off because you've squeezed out as much efficiency as you can in a lot of the business. And unless you're growing and getting more scale, or you're able to charge higher prices, you're maybe not going to be able to squeeze much more margin out of the business. So that's ultimately the challenge for Chewy, is how do you generate good profitability on both a net basis and an operating basis when you don't have a lot of pricing power, and really your power is just inconvenience? Are people willing to pay more for convenience? And this is where the valuation becomes really important, because I think Chewy could be a very profitable business, but it's not going to be an enormous business. And if we look at their operating margins, just 0.1%, same with their net margins. So just very, very thin margins. Can management get that up to 2, 3, 4%? I think that would be the bull case for the company. And the valuation is a little bit compelling. Enterprise value to sales is just 0.7, and enterprise value to free cash flow is a little under 30. So if you think about the opportunity that they have to expand those margins, those multiples might not be that expensive if you're able to squeeze a few more points of margin out of the business. I think long-term, that's the play for Chewy. And that's the reason this could be a phenomenal stock to own. I don't think this is going to be a company that maintains a 35% compound annual growth rate, which is what it's had over the last 5 years. We've seen that revenue level off. So now we get to a little bit more mature point of the business. How can they cut operating expenses? How can they improve gross margins? How can they get a little bit more efficient in their warehouses? That's what they've been focused on over the last few years. And I think that continues over the next few years. We squeeze a few more points of margin out. And that's why we start to see a recovery in Chewy. So this is definitely a turnaround play from a stock standpoint. But when you hear that a stock is down 84% from its peak, a lot of times you think that this is a company that's suddenly in trouble. But that's not the case for Chewy. Customers love their products. 75% of their business is recurring in nature. We're starting to see margins improve a little bit. I think we will continue to see that over time. And in retail, especially in e-commerce, it's good to be a niche player where you know exactly who your customers are, exactly where you fit in the market, and what differentiates you from everybody else. That is what we have with Chewy. And so that's why I'm bullish on the company long term. It could be a little bit of a bumpy road because these numbers don't improve overnight, and the market can react really violently with even the smallest of misses. But look for any weakness as an opportunity to buy. Well, what do you think about Chewy? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. And thanks for watching, everybody. See you here next time.